Okay, so this is just a brief overview of forwards versus futures. First to note, forwards, futures, almost the same. Very similar in terms of payoff profile and kind of how they're structured. The big difference, forwards are traded OTC, or over the counter. Basically that means, from one bank to another bank, or from one bank to another institution, like an investment bank or a broker-dealer specializes in trading these things. And so if a client wants to get a forward contract, they want to maybe reduce their risk to a particular currency, the client has to go to one of these banks. And then the bank will sell them the forward contract. And then they may, sell that onward to another bank. But the key point here is that there are just a bunch of sort of scattered institutions trading on their individual counters, if you will. And that's a contrast to futures contracts. And so while these contracts are similar in terms of what you can get a contract on and how they pay off, a futures contract trades on an exchange. And so this individual that needs to hedge their exchange rate risk instead goes to this central location. And I really should increase the size of this circle here to illustrate the magnitude of the size of the exchange, because it's not just this one client, but every client now doesn't have to go to a bank. They can just go directly to this central location where through this nexus they're trading with each other. And even banks will go here and trade through the exchange. And as a result, you have what's called a lot of liquidity. There are so many participants and so many contracts flying all over the place in the exchange that's very easy to find a buyer if you're selling, and very easy if you're a seller to find a buyer. And so you might ask, well, why don't I just always use futures instead of forwards? And that's a very good point. The answer to that is most people do use futures contracts. The one situation in which forwards are useful for using derivatives to eliminate exchange rate risk or other types of risk is that forwards very customizable. You can really get a forward contract on anything, whereas futures contracts, because you have so many different participants going in, there's got to be some standard of uniformity in this exchange. Like contracts have to come in specific sizes, $60,000 per contract or whatever. The strike prices or the strike prices would be for a option contract, but the equivalent for a futures price, the futures prices have to come in minimum increments, or they have to be linked to a certain amount of underlying. It's all very standardized on an exchange, and that standardization promotes liquidity, lots of trading. But forwards, since they're very customizable, that can be really advantageous. A company, for example, might need to hedge out its exchange rate risk, and it might be a very large amount, a very specific amount, perhaps because, and I've seen this before, they're doing a merger and they're buying a company in another country, and there's a very specific timeline that they need the currency to be the risk on that currency to be eliminated with a forward contract. It's got to occur, that risk elimination has got to occur at a very specific time period when that merger takes place, when the money actually changes hands. And it may be for a very large and very specific amount. Really, the only way that they can get that level of customization is going to a bank and arranging the contract with one of these banks. So there is a use for the forward market as well as futures. But as I said before, the forward and futures markets, aside from the fact that one is OTC and one is on an exchange, they're very similar in terms of their payoff profile. So with the forward contract, you start out today, and when you buy a forward or futures contract, the value of that futures contract is actually not worth anything. You're just sort of taking a position and saying, hey, the price of some underlying is this today, and what I'm betting on is I'm not buying the thing today. I'm betting on the price of that thing some point in the future. And someone who buys a forward contract only makes a commitment to actually do that transaction way out into the future. So the value today really is just the price of the thing today, but that value will change as soon as that contract gets consummated. As soon as it gets executed, the value of the forward contract will change depending on whatever the price of the underlying is doing during that time period. So the value here starts out at 0, but the value of the forward contract at the end of at the expiration date for this forward contract, that will be very different. And really, the profit for a forward contract, or loss, is the difference between the value at the end and at the beginning. The value of the forward contract, or I keep saying forward contract, but forward or futures contract will change based on when we are looking at this contract. So at any time t, while this stays the same, you paid a price for it, and that hasn't changed, the profit on your position will change. So to give an example, let's say the value, this is a futures contract on Google, and Google's price, the stock price, is at $1,300 at the beginning of this. And if I buy a futures or forward contract here, I don't pay anything up front. Now, that's not quite true. There's no cost to this forward contract, but I do have to do something called deposit margin. I have to put a little bit of money down that stays mine, but the margin goes to the exchange and is like it's like my deposit. Like when you rent an apartment, you put a deposit down. It's still your money. It's just that if you run away from your rent and you move out and stop paying rent before the contract is over, the landlord may keep your deposit. And the same thing is true with the forward or futures contract. You have to deposit some margin, because if there's a loss on this forward contract, you're liable for it. And this is part of what helps the exchange do this contract with you, because they know they can take this money if you run away, essentially. So you'll get this money back, assuming you have profit and not a loss, at the end of the contract, but not before. And you may have to deposit more margin if there are continued losses on this futures contract. The exchange will demand more money deposited because it's looking more and more likely that you'll run away otherwise. So forward contracts, they've got an expiration date and they've got a price at expiration. You can have a forward contract that's the same as the current price, say $1,300 at expiration for Google. You can also have a contract that's less. You can also have a contract that's more than the current spot price. That happens all the time, both ranges. But for simplicity, to calculate a profit or loss on a forward or futures contract in this example, let's assume that you bought a futures contract on Google. It's $1,300 today, and the price in which you locked in the right to buy Google at the end, let's say it's 1 year from now, is also $1,300. So to calculate the profit from this, you really just wait, and 1 year goes by, Google goes up, Google goes down, blah, blah, blah. If Google goes up and it ends up at $1,500, you've locked in the right to buy at $1,300, and you can immediately sell it for 1,500. And so that's what I was talking about, the VT minus V0. Your gain on this position is the 1,500 minus the 1,300. And all you had to put down for this position is the margin, which you got back in this case because it was a profit. So your profit is $200. And the thing with futures contracts, futures and forwards, the margin's really small. You may, depending on the security, put down as little as 10%. Maybe even for some currencies, it's as little as 2.5%. So for a stock, if it's 10%, then that means I only need to pay 10% of the current price of this futures contract. I only need to put down $130 to enter into this contract. And you can see here, I made $200 based on this difference because Google went up. And that's the massive effect of leverage. I made $200 on a $130 investment. And if I think about that on a percentage return basis, well, I spent $130, cost me $130 to buy in, and I earned a $200 profit on that. And so at the end of the day, on a $130 investment, then my percentage return, subtract out 1 here, is 1.53 or 153 percentage point return. So I spent $130. I got that money back. That was my initial investment, but I earned a pure profit of $200. Pure profit on 200 of 200 on 130 is 153%. But the point here is that futures and forward contracts really magnify gains or losses. And for risk management, for using derivatives to lower risk, that sounds like not a good thing. But a futures contract is not typically traded in isolation. A futures or a forward. You're using a futures contract or forward contract to offset gains or losses in something you're already invested in. And so while it looks like there's a big gain or loss relative to your initial investment, that's actually a good thing because what it means is that it's inexpensive to use this as a hedge. It doesn't cost you a lot of money to buy this additional security to help offset your gains or losses. For example, if I held Google stock, if I had $1,300 in Google stock already and I wanted to eliminate all my exposure to Google stock, I could simply take the opposite position on this futures contract. I sell one futures contract. And it's only going to cost me, I've only going to put down 10% of the money, $130 to sell that futures contract. And the net effect is that if this stock goes up, so that Google goes up by $60, then my futures contract is going to go down by $60. It's a 1-for-1 on the underlying for a futures contract. And so the net exposure to Google stock movements is now exactly the same. But if the price of Google stock goes down so that it's, let's say, below $1,300, 1,260 goes down by $40, then if that goes down by $40, the futures contract that I sold actually goes up by $40. And again, the net benefit, the net result is that I've got zero exposure to movements in the price of Google stock. So using futures contracts, and you know, this only cost me $130 to do. I only had to commit additional capital of $130, and the benefit is I reduce my exposure to Google stock. So one thing is that we illustrated an example here with buying a futures contract, and I just showed you an example with selling a futures contract. And this example here, the profit, this is for a profit or loss on buying a futures contract. We call that buying. When we're buying a futures contract, we call that long a futures contract, because we're sort of betting on the price rise here of Google. This profit, this position will increase in value if Google's stock price goes up in value. But you can take the other side of this. You can position yourself such that you actually make a profit when Google's stock price falls. And we call that shorting. Short, or oftentimes in the context of futures and forwards, sell a futures contract. The profit for that is different. To illustrate, we can take our same example, $1,300 for Google. That's the current stock price, and we are locking in the right to sell, not buy, Google stock at $1,300 1 year from now. We will make a profit if we're selling this futures contract, we're shorting, if Google's price falls over the next year. If it ends up at 1,100, the stock price falls, our short position, because it's profiting when the price falls instead of rising, we can still use the same formula here, VT minus V0, but you can see there's something slightly wrong with it, because we're locking in the right to sell at 1,300, and it's at 1,100 right now. But with a short position, I know that I should have made money. Like, I'm selling at 1,300 even though it's trading at 1,100. So there should be profit there, and that's absolutely correct. And so the one difference that we need to do to this formula to reflect that, when calculating the gain or loss from a short position or selling a futures contract, is that we have to multiply by -1 here. And that gets us exactly what we need. What the long gains, the short loses. What the short gains, the long loses. And so that's reflected by this -1. And here we had a $200 profit then, not a $200 loss, because we bet on the price falling. In fact, it did. Our profit is the difference between the rate at which we locked in to sell and the price it ultimately ended up at, plus 200. So for a short or selling a futures contract position, this is the formula you need. And for long or buying a futures contract position, then this is the formula you need. The only difference is the addition or subtraction of the -1.